I get asked all the time, why do you close your option trades early? And it confuses me every single time because why wouldn't I? I mean, I take less risk and I make more money daily. Aren't those two great reasons to close early? Hey everyone, welcome back to Drawbridge Finance. My name is Levi Woods. If this is your first time here, remember to click that subscribe button down below because I make informative videos as often as I can to help you guys make more informed decisions. I like to base all of my videos on actual math and then we can progress together and learn the power of trading options. Now remember, I don't offer financial advice. This is an opinion channel only about money. And today we're gonna jump right into this spreadsheet. Let's take a look. Now I'm sure you guys are familiar with this format. I use it all the time. This is my quick option calculator. I use this because it shows me exactly what the trade is when I enter it and it gives me my buyback target ranges. Now this is a trade I closed yesterday. I opened it on October 2nd and I closed it on October 13th, quite a bit earlier than I expected. I expected to hold this to expiration, or if I was going to hold it to expiration, be 49 days. But instead I closed it after 11 days with slightly more than 50% of the maximum profit. In fact, I made $223 instead of the $339 that I could have made had I held it to expiration. Now I'm going to show you a slightly different format of this so that we can take a look at why I might have done that. So the original investment, the maximum I could have lost on this trade was $1,000. Now the maximum profit I could have made was $399, but in order to make that, I would have had to hold this to expiration for a full 49 days. Let's just take a quick look at what would happen. Day 1, day 2, day 3. If we take the total $399 and we divide that by the number of days, we can see that we made $8.15 per day. Pretty decent return. I mean, it works out to 39% in 49 days. Or if we did it repeatedly, we would be able to do it 7.5 times per year. We get us a simple annualized return of 297%. We would have an annualized return of $2,974. This is amazing. Now, if we compounded our earnings, every time we made a profit, if we reinvested that money and put that money into a new trade, we could actually make a return of 551%. Now, this is super unrealistic. Remember, we can't win 100% of the time, and even when we do, we're not going to win with max profit all the time. There's going to be a choppy flow to any investment strategy because sometimes the stock's going to go against us and sometimes it's going to move with us. And what I want to do is I want to create the smoothest possible trajectory that I can for my portfolio. And instead of aiming for this $12,000 return on $1,000, I'm actually going to put on way more trades than that. And every single time I put on a trade, I'm going to recalibrate it so that it's got a better percentage chance of winning. What that's going to do is it's going to mean I'm going to win smaller amounts, but increase the frequency. And it's going to make it really smooth and it's going to make it ramp up way faster. And you'll see how it works. So instead, I closed early, I collected $223, but I only held it for 11 days. Now let's compare that down here. If we take a look, because I closed early, 223 divided by 11, my daily profit was $20.34. That's substantially higher than the daily profit of $8.15, isn't it? Now, if I can do that repeatedly, I'm gonna make way more money because that's the whole idea, is that I wanna make money trading. Now, by putting on way more frequent trades, I dramatically reduce my risk. And that's the second benefit. Now, it's really difficult for me to show the math behind that risk reduction, but I get emailed all the time from people that stay in the trades way too long. It's like, if you put on a trade and it's going for you, take the profits. It's okay to take profit and put on a new trade that you're confident with or that you might make more money off of. Let's take a look. The number of trades per year, 33 times I can make this trade if I did it every 11 days. My simple annualized return, if I didn't reinvest any of the money, would be 741%, or $7,422 off $1,000. Now, if I did reinvest my profits, would make an 80,000% return. That means I could make $800,000 off of $1,000 if I continually reinvested every 11 days and reinvested my profits. Now, super unrealistic because sometimes this is going to go against me and sometimes I'm going to lose. I can't have a 100% win rate, so we have to calculate that in. But I just wanted to show you an extreme example because it was perfectly timed. Let's just take a look at what happened. As you can see on this day, we had a down day, which is a perfect day to put in a bull put credit spread, which is what this was. I was expecting that Amazon was gonna rise up coming up to Amazon Prime Day, and that's exactly what we saw. We saw a little down day 2 days later. This would have even been a better day to enter this trade, but then we saw a nice 5 days up, and then yesterday I was able to take off this trade at profits, and then today it dropped back down. By closing early, I actually eliminated the risk and I got out of the trade because we don't know, it could easily drop back down, and if it goes below this line, I'm gonna lose money on that trade. So I don't wanna hold it for very long. This way I can put on a new trade based on the new information that I have. If I took that 223 and say hypothetically I did actually reinvest every single time and made the same profit, $20.34 per day, at the end of 49 days, holding to expiration would have given me $399. But by closing early, I could have made $996. Now that is extremely, extremely good. That's double in 49 days. 1,000 with $1,000 worth of profit. Now let's look at a trade that's a little more realistic. Now the reason I say it's more realistic is because I actually put this trade on 3 times in the same cycle. You can see right here in my notice, SPG, October, and then this 3 designated, it was the 3rd trade that I had placed on the same underlying in that month of October. Now let's just look at this summary that I've built for this video, which is the total investment was $16.74. That was the margin requirement. And then the profit per trade, if I held it to expiration, would have been $229. I actually realized only $92, so not very much. But my original expectation was that I was going to hold it for 25 days, and I only held it for 9 days. My profit per day was $9.17 expected, and you can see why I closed early. My profit per day jumped up to $10.30 by closing it on the day that I did. The return on investment was 13% expected, and I actually realized only 5.5%. I could put on way more trades per year, and that's where it's going to smooth out this data. So the simple annual return, 200% compared to 224, not much of an increase when you compare it like that. And when the compounding return 551%, if we were to reinvest this money all the time, we would have a 789% return, which means the $1,600 would return $14,000 in a single year if I was to repeat this trade all the time. Got this chart, and with a simple return, if we just invested the $16.74 and we held to expiration, I would be able to fully close the trade on the 25th day and then 25 days later do it again repeatedly, and each time adding that profit here. Now, the simple investment would be $229, getting $229 each time without actually increasing my risk each time. But I could make it compound. So I'll run the 2 different scenarios side by side. Here's closing early. So same investment, $16.74, and I made $92 after 9 days. Well, then 9 days later, I could make $92.70, and 9 days later, $92.70. I'm sure you kind of follow this. We'll do compounding holding to expiration, and we'll compare compounding closing early. Compounding closing early, I made $92. Then I made $97 because I was actually able to reinvest the $92 that I made, reinvested it so that I made $97 the second trade, then $103, then $108. Meanwhile, we've got $229 compared to $260, so on and so forth, all the way down. And when we get down to the bottom, we can see the difference, that we would have a net value of $4,885 if I held to expiration. If I closed it and opened new trades, I have a $5,300 return. So almost $500 difference by making more trades. Now, if we compound the returns, it's even more dramatic. $10,000 compared to $14,000. The important thing to take away from this is how smooth this becomes. I've actually put these steps in here so you can see what would happen as you were going up, because that's what we don't want our account to look like. I don't want these like big rises, big falls. I want to see this massive sweeping trajectory of like just an account growing nice and smoothly and upwards, because I want to get rich with you. That's the whole intent of this channel. Now, I'm super excited about my next video because I'm going to be releasing a spreadsheet which is going to be able to track your trades. I'm going to show you my last 100 trades. I'm going to show you how much the margin was to enter each trade, and I'm going to show you how much my average profit was. Then we're going to be able to project that data and just see how fast an account can grow. If you're not a member of our Patreon community, you can come chat with me daily on Discord, because I want to get rich with you together. I mean, that's the goal. Education, trading, and making money. Ciao.